Today in InvestTalk, we look at changes the Secure Act 2.0 brings to the retirement landscape. Then we tackle the bullish start of this week's market action. We also answer questions about Uber, Dell, United Rentals, and more. And at the end, we discuss if the Bitcoin bullishness post-election is warranted.
This is InvestTalk, independent thinking, shared success.
Now let's pivot over to our main focus point, and that is in regards to the Secure Act 2.0 and how it is impacting RMDs for 2024. And the original Secure Act was passed only 5 years ago, and it moved the RMD age from 70 and a half to 72, but a lot of lawmakers thought that did not go far enough, and so they ended up proposing and passing the Secure Act 2.0. And really, the major change here is the move in the RMDs, the required minimum distributions from IRAs and 401ks, and not just moving it to 72, but moving it to 73 as of 2023, and then it will go all the way to 75 in 2033. So for now, it's 73 for RMDs.
Yeah, and another change it makes is it reduces the RMD penalty to 25% or 10% if corrected within 2 years, and also adjusts the statute of limitations, starting from the tax return due date rather than the filing date, which would potentially help some avoid penalties if the IRS assessments are delayed.
There you go. And on the Roth side, it was always kind of odd that Roth 401ks had RMD requirements, because the point of RMDs is that the government wants their money. Eventually, they want to tax your money, and the RMDs are a way to force money out of IRAs and have you pay that. Whereas Roth, you've already been paid, so it kind of didn't make sense. But the Secure Act 2.0 allows Roth 401ks to not be subject to the RMD rules before the account holder passes away.
You know, another issue was complexity, right? So what this tries to do is it tries to simplify RMD calculations for retirement accounts with annuities by allowing distributions from both annuity and non-annuity parts to be combined. It also makes annuities more attractive by permitting specific payment adjustments and expanding the use of what's called qualifying longevity annuity contracts, or QLACs, raising the limit to $200,000 and eliminating the 25% cap.
Yeah. Yeah, I think that was that was a gift to the insurance industry, which obviously
Certainly.
Probably lobbied for that. And then another change was RMDs for surviving spouses. Now, it basically moves it so if the account holder dies before RMDs are required and their surviving spouse is the beneficiary, RMDs from the inherited account aren't required until the year the deceased account holder would reach 72. Now, the tweak around Secure Act 2.0 is that it moves that to the RMD age going forward. So that basically will move it to 73 because the deceased, it's based on the deceased account holder's age. But then obviously in 2033, that RMD will move to 75. And then that will be the required age for RMDs for whoever inherited that IRA.
And then the last change is really around how qualified charitable distributions will effectively lower your RMD. So what it does is it adjusts the $100,000 annual QCD limit for inflation, raising it to $105,000 for 2024, and allows a one-time $50,000 QCD to certain charitable trusts or gift annuities starting in 2024. Is that correct? 2024?
Yeah, and 2023 actually.
Oh, 2023. Sorry, as of last year.
Yeah. So that's the one I think beyond just moving the RMDs up that I like the most. I love when they index these things to inflation because, you set something in place and obviously inflation will kind of change the effectiveness of that rule over time. So getting that link to inflation, I think will be important as well. Now, Luke, let's take a quick look at the market today. It was a decidedly positive day overall. You had the S&P up about 40 basis points, the NASDAQ up about 60 basis points. And what else did we have? What did you see? What did you see in markets?
We have small caps only up 11 basis points, not big movement on the bottom end of the market there. I think generally speaking, It was just a bounce really from last week, which had some pretty negative sell-off towards the end of the week, if you recall, right? The S&P 500 and the NASDAQ both shed, 2-3%. And so you just kind of see this bounce back as we enter this period of really calm before the storm of changing federal policy, right? People are just at this point in time trying to interpret what moves may mean for administrative policy moving forward and what that effect that could have on interest rate cuts, the path of interest rates. And so it seems to me like we have more likelihood of positive tailwinds than headwinds heading into the year, with positive seasonality, with share buybacks and all these things that could elevate valuations and elevate stock prices headed into 2025.
Yeah, I agree. There's not a whole lot of economic data. Maybe some CPI numbers coming out. I know we have obviously the jobs number for November will be important too. Fed policy path, and we have NVIDIA earnings. Is that tomorrow?
I believe it's the 22nd, if I'm not mistaken.
I know it's coming up because NVIDIA obviously a big part of the indices nowadays, and
20th.
Pretty much a 20th. Okay, so day after tomorrow. So it will be in NVIDIA, of all the the large mega cap tech companies, I would say it's the most volatile potentially, just because it's kind of new to the size, and there's a lot of expectation for earnings. And if obviously market doesn't hit those market expectations, it could fall or continue to surge higher and have more short covering and really have big movements. I think the market's pricing in a 10% movement one way or the other. Obviously, it may not move that much, but that's what the market is kind of pricing in. So that'll be big going forward. And like you said, we're starting to get into what do we have? A week from Thursday is Thanksgiving. So once you get through in Thanksgiving, you get into that kind of light holiday trading. And markets tend to float up, especially in years when stocks are higher. People don't want to take profits until the first of the year, so often they wait. And so there's a lack of sellers, and then you have kind of consistent buyers into year end. So that's kind of what we're seeing, a lot of market structure issues that are likely to keep the markets moving positively through year end.
Hi, Justin and Luke. I was calling in to get your opinion on KKR Financial. The symbol is KKR. What is your opinion on getting into this sector, and what would be a good entry point? Thank you, and I'll be listening to the answer on your podcast.
All right, looking at KKR, this is one of the largest alternative investment management companies out there, and they're usually pitching their funds to the institutional market, endowments and such. And their business is doing very well. Earnings are supposed to be up 38% this year to $4.72. Now that is down from their all-time high in earnings of $7.31 in 2021. But the stock is at an all-time high. Luke, why don't you give the audience your perspective, kind of on this space as a whole?
Yeah, well, I think we talk about this pretty frequently because people call in not necessarily about firms like KKR, but they may call in about BlackRock or Vanguard or all these firms who essentially their business model is based upon the fees that they get, right? So it's pretty clear to understand that as AUM goes up, as flows are coming in, should your fee level not change, that's how revenue grows. But what we've seen across the industry broadly, right, is fee compression. And so this is something that KKR suffers with as well. But even with that in mind, right, from 2023 until this year, this upcoming year, through the end of this year, right, management fees are supposed to grow from $3 billion to $3.4 billion. So that's certainly something that is impressive. I'm seeing their cash flow has been improving consistently for the past 4 years. But the thing that I think that I see that may be a little, that may cause me to hesitate, right, is taking a look at their forward-looking price earnings, 25 times, price to book 5.5 times. That's the upper end of their range. So maybe this is a situation where it's a company that's done well in an industry that's done well, but maybe a little bit overvalued. What do you think?
Yeah, and I worry about, I've talked about this with a lot of the private investments that are out there, private REITs, private debt vehicles, et cetera. There's not a lot of clarity into how those have been structured. And the risks that are involved. And so while things are going well generally in the credit markets, I think this will continue to do fine. But if there's any upset, any alarm. We see that with remember what was the Brookstone REIT that was cutting redemptions. That's something that was a kind of a red flag, I think, in the private REIT space. Now, you haven't had a lot of those big headlines around the private equity funds and a lot of what KKR deals with. And so I think right now that's fine. But I worry that there's been a lot of misallocation of capital in that space, and that will eventually come to light. Now, that might not come to light for another, year, 2, 3, 4 years down the line. Who knows? And the technicals are certainly fine on this. So I think from a momentum perspective, it's fine. From an earnings perspective, like you said, their cash flow is improving, their business is improving. I just think there's a very high risk at these price levels. So I wouldn't buy it for the long term, but maybe as a trade with a tight stop, probably at the 100-day moving average. Thanks for the call. Now let's go pivot to a live call and talk to Sid in North Carolina looking at Uber.
Hi, Justin and Luke. Thank you for taking my call.
Of course.
Yeah, I have been hearing some news on CNBC and other things. Is this a good company overall in your view? And if yes, then what is the entry point that you are looking at? Uber looks like some of the numbers are quite okay, but I'd like to hear your opinion. Thank you so much for your time.
All right, looking at Uber, I don't think we need to tell everybody what Uber does. Now, I will say from a technical perspective, this is somewhat the opposite of KKR. I'm actually seeing some pretty bearish move over the past, 6-7 weeks now. It peaked out around $86 and change. Now we're down to $69 and change. And this looks like it's rolling over after this long rally from the summertime of 2022 when it bottomed around $20 per share. Now, from an earnings perspective, Luke, it looks like earnings supposed to be $1.79 this year and $2.37 next year, which would be an all-time high. But $70 stock, is it worth 30 times forward-looking earnings? What do you think?
Well, I do want to start by saying it is an impressive company in that, right? This last year was the first year that it was actually profitable. And a lot of people have been holding on for a long time, trying to get some profitability in there. And certainly over the past 5 years, their cash flow has improved and their revenue has grown pretty significantly from $11 billion back in 2018, projected to be about $43 billion this year in terms of top line revenue. And as I mentioned, their margins, obviously they're improving because now they're starting to make money. They had negative net margin for about 4 years. Then they had 5.1% last year, projected to be about 8.8% this year. So the margin expansion is something that I like as well. Potentially, maybe in the past couple of days, there was some positive news that could have driven the stock price higher. Maybe you see a drop off today related to the fact that a former executive was on the short list for the transportation department, though President-elect Trump did announce somebody else, not the guy, a former lawmaker, rather than somebody out of Uber. That could have been related to some of the price drop off today. But I do think, like you said, there are a little bit of risks out there for the company being this expensive.
Yeah. And I don't like the combination of companies that are trading at high multiples and then poor technicals. It tells you that the market is starting to re-rate the multiple lower. And I'd like to see this settle out and earnings to become a little bit more consistent. I think the positive here is generally people are getting used to taking Ubers and doing Uber Eats a lot more. So from a consumer habit standpoint, I generally like this space because it's just becoming the norm. And Uber, it tends to be kind of a winner take all type of platform. But I would be patient on this and have this come back in. This needs to probably get to around 50. That's where, if I'm zooming in on a weekly chart or zooming out, on a weekly chart, let me give you a major support level. Yeah, somewhere around $45, 45 to 50. I think that's where it lines up from a technical perspective and a fundamental perspective for me to buy Uber. But I would be patient on it for now. Now let's pivot over to a question that came in via our YouTube channel, a comment section on our YouTube channel. CJM asks, hello, InvestTalk. What are your thoughts on Dell? What is a good entry point? Now, Dell Computer, a company that went private, and then went public again back in 2018. And it's been a big winner. It went public around $20 per share. Now it's at $136 per share. So pretty big run, Luke. What are you seeing on the valuation front right now?
Well, on the valuation front, I think that taking a step back, talking about cash flow and profitability, while you see cash flow kind of being stagnant over the past 5 years, because this is really going to inform really how the valuation looks relative to the improvement of the company. Well, forward-looking price earnings, about 14. That's pretty low for what you'd expect in terms of companies within the computer hardware business. Price to cash flow at about 15. That's near its 5-year high. And so generally speaking, right, on every valuation metric we're looking at, you can see that it's at or below its 5-year average.
That's kind of nice. It says even though it's ran, it's still relatively cheap, right?
Yeah, that's definitely what it says. But I mean, you also have to keep in mind that this is a 5-year average and a lot of different things happened within the past 5 years, right?
That's
Part of it had to do with the pandemic. A lot of people were upgrading their tech. A lot of people were upgrading their home offices. A lot of people were doing spending. And then you got to think about the cycle of buying these types of things, right? Hardware advances until it reaches a point where software needs to improve in order for new hardware to be generated. And so cyclically buying or consumers' cyclical purchases of computers and whatnot also has an effect on that.
Yeah. I mean, the good thing here is that even though you're right that you got that surge in demand from the pandemic, their profitability has now reached an all-time high since they went public again in 2018. So I like that. Although, obviously that's driven by AI investment. Their servers and such are part of that big CapEx spend from a lot of the big tech companies. What I don't like, though, is the technicals are actually weakening. It peaked back in May, when it peaked out around $175 per share, then fell, rallied since, but still hasn't broken above any major supports or major resistance. So, I still don't love it technically, although I like the company longer term. I just don't think this is the time to jump in on Dell. Thanks for the call.
Well, I have a small stake in that. I bought it about 1.5 years ago, and since then they did a stock split, and then it's run up over the past month. And I'm wondering, what would a good point be to increase my position in that?
Well, that's a tough question. Now, first off, I'll give the positives for AAON. The positives are it's profitable, very profitable, and it's good return on equity, 25%, return of invested capital around 24%, and its 5-year median return on equity is 23%. So it's consistently profitable and has pretty solidly positive free cash flow. That's good. No debt, pretty much, on its balance sheet, very little. And those are the positives. But Luke, you're seeing some negatives on the valuation front, right?
Yeah, right. Because it's more than just about finding good businesses. It's about finding good businesses at fair prices. And this thing is trading at pretty much the higher end of its 5-year range. I mean, it's an HVAC company trading at 46 times its forward-looking earnings. It's an HVAC company trading at 13.6 times its price to book, 45.6 times its cash flow. And the reason why it's doing that is, well, people are anticipating the growth streak over the past 5 years, which was 21.9% on an annualized basis, to continue. But for me, this looks to be one of those names that is certainly has earned the run-up it's had over the past year. But the growth projections to me just seem a little out of left field. I don't know. What are your thoughts?
Yeah, I think the run that it's had is put this in a very overvalued position. It bottomed in early 2022 around $32 per share. And now it's all the way up to $131 per share. So it's quadrupled since then. And so I see that as a valuation that is out of whack here based on forward-looking earnings. Even if they earn nearly $3 per share next year, so it's supposed to be $2.94, you're talking about a 40-plus multiple for an HVAC company. And yeah, they're growing, but is this growth going to be sustained? I don't really think so. And even if you look at the free cash flow, it's only $100 million, which is good, but that's flattened out over the past couple of quarters. And you're talking about a free cash flow yield based on enterprise value of 1%. That's not very good. And, enterprise value either on 36% or 36 times, price to sales around 9 times for an HVAC company. It's just out of whack. So where's a good price to add to it? I don't know, 50 to 60% lower from here. That's probably the only time I would actually be thinking about selling this more than I would be adding to it at this point. It's surged. It's starting to weaken a little bit over the past couple of weeks. And to me, it's more of a sell than buy anytime soon.
Very good. Thank you so much.
No problem, Paul. Thanks for the call. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we thank them for courtesy by getting to their questions quickly. And from ASE says, I have shares in URI. I'm up on it. Want your take. Sell, hold, or trim. URI is United Rentals, and a name that has done very well as of late. It's coming off an all-time high. But earnings are supposed to be $43 a share this year, $46 a share and change next year. And it's an $832 stock. What are you seeing, Luke, from a valuation and trend standpoint?
Well, their cash flow has improved pretty steadily since the end of 2021. One trend that I really like is they have consistently bought back shares over the past 3 years, down from over 75 million shares outstanding in 2020, just about 65 million shares outstanding now. They pay a 78 basis points dividend yield, but their payout ratio is only about 16. So they have a lot of room to run there. In terms of their debt, well, 14 billion in debt on a $54 billion market cap company. And that is trending higher. Their debt levels are up from about 10 billion in the pandemic. And so then with all of that said, what's it looking like on a relative valuation basis? Well, it's again at the upper end of its range, which really a lot of companies are right now, right? Elevations are very elevated right now. So it's trading at about 6.4 times price to book, about 11 times cash flow. That is certainly on the upper end of its range here. So I think this to me seems like another company that may not necessarily be a sell on my end, but certainly a hold right now at best.
Yeah, I would agree with that. Especially if you look technically, you are getting what we call MACD divergence, meaning it's making a new high on the weekly, but the MACD is not. And so it's showing you that momentum is certainly waning. And if you look at the earnings growth is waning as well. And because a year ago, plus their earnings growth was in the 20s, up in even the 30% range in fourth quarter of 2022, first quarter of 2023. But last quarter, earnings growth was only up 1%. Sales growth was only 6%. And if you look going forward, sales growth is only projected to be around 4% next year, and earnings only in the 5 to 6% range. That's not that great, especially like you said, Luke, trading at kind of near all-time high multiples. So you line that up with the fundamentals, or with the chart, and that growth waning. I think this is ready for a multiple contraction. So I would be at least trimming it here, and I would have a tight stop on it. Let me give you the stop. Yeah, honestly, if this broke below the election night lows, which would be kind of right around $780 per share, this would be a sell for me. I think the technicals would certainly be breaking at that point. And once again, you combine that with the fundamentals. I just don't see a reason to hold on to it for very much longer unless the momentum just picks up to the upside. All right. Thanks for the call. Now, Luke, let's talk a little bit about Bitcoin. And Bitcoin obviously surged after the election, and it's at or near an all-time high. Let's see. What is Bitcoin at now? Is it
around 91,000?
91,000, which is kind of near the all-time high, or 90,586 right now. All-time high was sometime last week, right around 95, if I remember correctly. So, it's obviously done very, very well since the pandemic. And a lot of enthusiasts are excited about some changes that a new Trump administration would bring. The first would be a change to the SEC. Obviously, Gary Gensler is not a big fan of cryptocurrencies, crypto listing, exchanges, mining, etc. And all of that could potentially change under a Trump administration. So, Luke, do you think that the community has this right, or do you think they're overstepping their enthusiasm?
Well, I think there's two parts to this. You see rumors flying around about the Trump administration wanting to have no capital gains taxes for U.S.-based projects and a strategic stockpile of Bitcoin. And so what the market seems to be pricing in, the crypto market seems to be pricing in, is this best case scenario right now. Right? It has surged exponentially since the market broadly since the election. And so the question is, well, is it likely to get the best case scenario? The US federal government is an incredibly unruly body that is difficult to turn. And so even if they do try and move towards that scenario, well, then that takes time as well. And so that may be a little bit of an overstep. The second part of it is if you're loosening regulation, that would inherently help new cryptocurrency, but Bitcoin is not really one of those things that's being attacked by the SEC, right? So I don't really see how a change in regulatory relationship with the crypto market necessarily benefits Bitcoin so much as it does some of the other projects.
Yeah, I think that's the best argument here is that Bitcoin is already treated as a commodity, and which means it avoids a lot of direct SEC oversight itself. It has futures connected to it. It has obviously ETFs connected to the price of Bitcoin. It's kind of those other altcoins that would be treated with a lighter touch during a Trump administration. And so outside of Dogecoin, if you look at the other altcoins, they're underperforming the move in Bitcoin. And so net, you would imagine that this would be more beneficial for those altcoins itself. But there's a few arguments that says maybe that's not true. Now, the first would be that, Bitcoin is the name brand, and it's the biggest crypto. Therefore, if this is good for crypto, then ipso facto, you buy Bitcoin. And obviously, there's no fundamental valuation of Bitcoin, or any crypto. And so it depends purely on sentiment. And so sentiment drives buying when people are excited about the space, and net, they buy Bitcoin. What do you think of that argument?
No, I think that's entirely fair, but I think that the first argument that I made is kind of more the one that I lean on, which is we are pricing in within the crypto space mass adoption. And not only mass adoption, but government-sponsored mass adoption. And not only government-sponsored mass adoption, but essentially zero regulatory bodies at all whatsoever. And I just think that the U.S. government, again, is an entirely massive, unruly body to move, let alone move quickly. And so I just think there's a little bit of irrational exuberance here.
Well, and speaking to that, the other argument for why Bitcoin has surged over the altcoins is that the Trump campaign promised a strategic national Bitcoin stockpile. Now, as you said, that may or may not happen due to the unruliness of government bureaucracy. But, the big question is, where will these dollars come from, especially if Trump and his, the Doge administration, Elon and Vivek, are trying to cut spending and try to streamline the government? Are they really going to divert American resources, dollars that could be used to bring down the debt in order to buy Bitcoin? I think that's a big question here, is what will those priorities be? Because as we know, we're in a tough fiscal situation, and putting this at or near the top of the list of priorities to get our fiscal house in order, I think would be a hard sell. And it's still hard to predict what the new administration would do. Now, the third argument centered around Bitcoin surge, is that Bitcoin is an inflation hedge, and the market is pricing in a Trump administration being more inflationary. The hard argument there is that historically, Bitcoin has actually been a poor inflation hedge, and it moves more closely with speculative stocks like the NASDAQ than it does inflation, which if you want to bet on that, you probably want to bet on gold. So what do you think of that?
Yeah, I certainly agree with you there. I've never understood the argument that Bitcoin is an inflation hedge. You can call it digital gold. It does not make it digital gold. There is no, as I'm aware, industrial use for Bitcoin as there is for gold. There are not countries that are stockpiling, or rather that can use their stockpile of Bitcoin to do anything other than transact on a payment network. So I never fully understood the argument behind it being an inflation hedge just because there's only 21 million of them.
Yeah.
Or will only ever be 21 million of them.
Yeah. Well, Bitcoin, either way, I think we all can agree, price is built mainly on animal spirits more than any hard economic analysis. Now, let's move things along and swim back to the InvestTalk voice bank. You know the number, it's 888-99-CHART.
Hi, guys. This is Kevin calling from La Crescenta, California. I was calling to ask about a company, Autoliv, or Autoliv. Ticker is ALV, as in Victor. They supply safety equipment like airbags and seatbelts to a lot of different car companies from around the world. I know it's sensitive to economic conditions, but seems to be at a PE ratio at or below its like long-term average. And I'm wondering if this is a good stock to pick up for long-term hold. Appreciate your thoughts as always. Thanks.
All right, looking at Autoliv, it's a global leader in passive safety components and systems for the auto industry. Think seatbelts, front airbags, side impact airbags, steering wheels, etc. Now, their largest customer is Renault, Nissan, Mitsubishi, 10% of sales. Stellantis accounts for 10% as well, so a little bit smaller, but Volkswagen, 9%. Okay, and 34% comes from the U.S., from the Americas, and then followed by Europe, 27%, China, 20%, and the rest of the world, 19%. It's about a $7 billion market cap here. The technicals, though, are not that great. It peaked out around $128 per share back in May, and now it's down to $98. So the technicals, I would say, are poor. What are you seeing on the earnings and valuation front?
Well, in terms of earnings, right, they have seen some earnings growth from 45 in 2022, earnings per share 45, projected to be 8.15 this year, 10.06 next year. Their margins are generally expanding from a low of 2.5 or 2.5% in 2020 to 6.2% this year. Technically, you're right, it does look poor. One thing I'm interested in is, given the exposure it has to China and the role China has in the EV market, how can this company benefit asymmetrically from its competitors?
Yeah, I think that's a big question. I do like that they are buying back shares. They do have, I think, a reasonable amount of debt on their balance sheet. Free cash flow is nice, around $493 million, which is near the high end of its 10-year range. But it's a solid company with good profitability. I just worry about those technicals. It remains weak, and obviously, if interest rates continue to rise, I think that could hurt auto sales. So I would pass on it for now. I think it's a fine company. I just want to see the technicals improve before I would jump in. Here's another question from our InvestTalk YouTube channel. Randy23 says, would love to hear your thoughts on TDG, TransDigm Group. Thanks for all you do. All right, looking at TransDigm or TransDigm. DIGM? How would you say it, Luke?
TransDigm. Let's go with that one. It sounds more professional.
It does, right? Well, they manufacture and service a diverse set of specialized parts for the commercial and military aircraft industry. So they have 3 segments: power and control, airframes, and small non-aviation segments. Okay, mainly off-road vehicles and mining equipment. Interesting here. They're doing very well. If you look at earnings, they were pre-pandemic, they were $18 per share. Now, this year, it's supposed to make $37 per share and $43 per share next year. But Luke, the stock has rolled over. It peaked out around $1,450. Now we're at $1,252 per share, below all the major moving averages. I definitely don't like the technical setup. What are you seeing on the fundamental front?
Well, the revenue growth is pretty solid over the past 5 years on an annualized basis, about 8.7%. And most of that is pretty evenly split. They did dip down in 2021 during the pandemic, but there's been a pretty solid growth rate since then. Their margins look pretty solid, about 18.7% net margin as of this most recent fiscal year. They have a lot of debt. They got $24 billion in debt on a $70 billion market cap company, and their interest coverage ratio is only about 2.87 times, which is still fine, but probably a little less breathing room than a lot of other companies would have. I think from a thematic perspective, right, it looks like only 2% of their revenue comes from non-aviation, 50% from power and control from those airplane systems, and 28%, or rather 48% from airframes. And, I think over the next 4 or 5 years, what you're probably going to see is aerospace defense companies doing particularly well as some countries in Europe rearm. Certainly, air forces is a big part of that. And so I think thematically they have it, but I am worried about the debt levels here.
Well, if you're listening to the market and you look at like Lockheed's actually doing very poorly since the election. So is the market actually pricing the opposite? That, if, say, the Trump administration is trying to do what they say, which is cut largesse in the government, I certainly think there's some military spending that could be cut, right? And is that what the market is telling you? And TransDigm, along with Lockheed, is part of that?
Potentially, but also if you look at TransDigm, right, 37% of its revenue is foreign. And so, yes, if the U.S. decides to cut military spending, which still stands to be seen, I could probably have $1 billion in my pocket if I, called the bluff on every time a leader said they were cutting military spending. But, if the U.S. does cut military spending, they do cut foreign aid. Who has to rearm, right? Countries that have generally been under the umbrella of U.S. protection. And so 37% of their revenue is coming from outside of the United States, from European markets, from Asian markets, right? Japan generally has been a little bit remilitarizing. Post World War II, we demilitarized them. And so the growth, I'm not necessarily saying comes from the United States. It comes from the foreign markets, rather.
Yeah. Yeah. And I definitely hear that argument. But I'm looking at valuation too, and it looks pretty steep. Price to sales 9 times. We know anything above 10 is usually very, very extreme. Especially, usually those are reserved for tech companies. And obviously this is not a tech company. You have free cash flow about at $2 billion on a $89 billion market enterprise value. You're talking about a 2.5% free cash flow yield. Nothing crazy or exciting there, to be honest with you. So enterprise value either around 23, which historically is near the higher end of its longer term range, which ranges from about 8 all the way up to 30. So, I don't like it there, and I don't like the technicals. So I just don't. I'm not a fan of this. I just don't like the trends in earnings as well for this year and next year. Those are coming down, and so there's a lot of strong expectations built in that I just don't think this name is going to live up to. Those are my thoughts. All right. Lastly, before we close, I want to get into some interesting news around. Oh, I guess we don't have time. I wish I had time for this. I don't have time. We are closing up. I'm Justin Klein,
Close for business,
along with Luke Guerrero for this episode of InvestTalk, and we thank you for listening. And we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your investor risk number by heading over to investtalk.com, click on the portfolio review button, and taking advantage of our free and confidential portfolio review. Now, if you haven't optimized your 401k, we can help you there as well. And you can start by heading over to investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.